Hello, this is team number 23. My name is Yuan Chengge. Our project is optimization of investment portfolio. We'll follow this order for this presentation. First, I'll give you the introduction part. A portfolio is a collection of financial security from various asset classes, which could include stocks, foreign exchange, bonds, commodities, and derivatives on these asset classes. Portfolio optimization is the process of selecting the best possible set of stocks out of a set of all stocks considered. The selection is based on a particular objective, which is maximizing the expected return of the portfolio. In this project, we attempted to build a framework which can help us assist in the fundamental analysis process. More specifically, we focus on the quantitative components, which will analyze how individual stocks perform relative to itself, as well as the broader stock market, using common company-specific financial data. Portfolio construction is a huge area of focus in the financial industry, as there is a very high demand of improved returns with similar risk profiles. Machine learning is becoming a more and more popular tool in portfolio constructing. Using the vast amount of data available, range from time series to financial data of companies, to various alternative data which may or may not seem intuitive at first. In this project, we would like to apply machine learning algorithms to financial time series data. We plan to build a predictive model that will assist us in generating alpha. Our portfolio will be benchmarked against a very popular index used predominantly by major fund houses in the US, called S&P 500. That's all for the introduction part. I'll pass to Sun for the data part. Thanks.
Thank you, Chengge. My name is Sunam. I'll be covering the dataset and pre-processing part. Our dataset is sourced from Bloomberg. We downloaded financial data of 505 stocks from Bloomberg in form of CSV files. Each CSV file contains 10 years of data, as there are 12 columns and roughly 3030 rows in each CSV. So the total data points for each CSV is around 36,360. And in total, for 505 stocks, we have 18,361 nearly data points. In the left side, you can see there's a list of all the 505 stocks, and in the right side, the corresponding CSV files we downloaded from Bloomberg. If we look into one data file, we can see the header is a multi-level header. In the first row, it contains the ticker name or stock name. In the second row, it contains the column names. We kept the same format in the merged file because it is easy to retrieve a specific field for all the tickers together. For example, in the next screenshot, we can see how easy it is to find the PX last for all the tickers together. For our pre-processing, we used Python and its library pandas. First, we loaded each data file into a data frame, and then we added a datetime index to each data frame. Based on that datetime index, we did outer join merge with other data frames to get a merged data frame. That finally merged data frame is a horizontal merged data frame containing 6060 columns and 3030 rows. We also did additional verifications to ensure that each data frame contains equal number of columns, that is 12 in our case. If we find any column is missing, then that column gets added to the data frame. Here we can look into the snippets. The first image shows that how we are reading the data file into a data frame with the header parameter as 0 and 1, and this shows that we are loading a file with multi-label header. The second snippet shows how we are verifying the column numbers in a data frame. If there are less than 12 columns, then we add that column back to the data frame. And the final image shows that how we are doing an outer merge based on the index column. This table shows our data file merging stats. We merged 505 files with average 12 number of columns, 2534 number of rows, and finally you got one merged data frame containing 6060 columns and 3030 rows. We saved that data frame into a file so that we can reuse it later in our further processing. As we deal with 10 years of data, there might be some inconsistency that we'll be handling in the preparation and cleaning section.
We notice a few areas which requires attention as we prepare the data before training. One source of problem is the fact that in the actual S&P index, over time, new companies are added to the index and some existing stocks are removed from the index. Another area is that the market data, which includes the price, the volume, etc., are much more frequent on a daily basis, while the financial data of the companies are typically released once a quarter. Therefore, over the span of 10 years, we have approximately only 40 data points for each company's financial data, while we have over 2,500 data points for the market data. Another area that we have encountered problems is that sometimes the data may simply not be available. For example, if a company is not being profitable, then there will not be price to earnings ratios. Or if the company does not pay dividends, then we won't have any data available on the dividend payout ratio. We try to keep a simple approach to solving these problems for the purpose of our project. For example, we assume that over the whole period of time, the number of stocks remain the same and constant. For the quarterly data, which are not as frequent as the market data, we used straight line linear interpolation such that we would have enough data points for the whole period of time, and small increments of the data are observed rather than a big step between quarters. We also had to analyze the data set that we have to make sure that all the stocks that we're using has enough data. Otherwise, there might be problems during the training. So after analysis, we've sort of redefined our index with a simplified version such that all the ones that we are using will have sufficient data. And at the end, we were able to come up with 308 stocks out of the 500, which fulfills the criteria and allows us to have very little missing data, which we can train into our model. In addition to all the features that we already have in the dataset, we've added the percentage change for each period of these features as well, because we think that for some of these features, looking at the rate of change is much more insightful than just looking at the absolute levels. Another consideration we had was how to actually label these stocks for the training, because there is no inherent labels. Basically, we used a very naive approach and we rank the daily returns of the stocks in sequential order and basically splitting them into equal buckets um, and assign a certain weight for each bucket. We then were able to use this whole data set into our training model.
Now let's talk about algorithm design. Step 1 is cleaning the data. Out of 504 stocks, we filter out 197 because of insufficient data and only 308 stocks are retained. In step 2, we use linear interpolation method to fill empty data points. This is the best way to interpret null values for any time series data. In step 3, we employ the bucketing method to classify the 308 stocks into classes within a given range. In step 4, we calculate stock returns, weights based on these returns, and weighted returns of each stock for each of the trading days. In step 5, we calculate fund and benchmark returns for each day. Fund returns is calculated as sum of weighted returns of each stock for each day. S&P 500 benchmark returns is calculated in the more traditional way, that is total market value by total shares outstanding, where total market value is the sum product of stock price and shares outstanding of that stock, and the total shares outstanding is the summation of outstanding shares of all stocks on a given trading day. Now we compare both returns. The main objective of this project is for the model to consistently beat the benchmark. This would mean that the fund is profitable and is consistently able to generate alpha. In step 6, we split our dataset into two parts, one for training the model and the other for validating. In step 7, we generate ratios for each of the features. This helps to generate a better model for prediction. In step 8, we transform our data. Machine learning models train better if we have more examples to train from. However, our input data has only 3030 rows to start with, and so we realign them vertically to generate more rows. We'll talk more on this in a later slide. In step 9, we train the model. Research has shown that deep neural networks are best suited to model time series data, especially financial time series data. So we use DNNs for creating the model and all of our testing. Linear classifiers can also be used, but the results are similar to DNNs. Once the network is created and ready to be trained, the weighted returns computed in step 4 are passed as initial weights for training the network. Based on this and other features, the model is expected to classify stocks. The last step of the process is model evaluation, which tells us how good our model is. We talk more on this in later slides. Vertically realigning our dataset basically means placing stocks one above the other instead of side by side. This helped us increase the number of rows for training the model. Date and stock names were preserved so we could reconstruct the original horizontal format back once the model predicted the new classes. With the original data structure, we recalculated weights and weighted returns as well as the overall fund return. We then compared this with the benchmark return for the state. In cases where the fund return was better, it meant that the model outperformed the benchmark. Let's have a look at some of the testing scenarios and the model's results. The first scenario provided the model with 10 classes to choose from, and the weight ratios for each class was decided to be between 0 and 10, as can be seen in the images on the right. The second scenario provided the model with 25 classes, and the weight ratios for each class was decided to be between 1 and 30. This table shows the combination of data that we've used for both the scenarios. We split the dataset into training, validation, and test. The model is trained with combinations of 60% for training, 40% for testing, similarly 70-30, 80-20, and 90-10. The before and after rows column under training and testing dataset show total rows that are converted from horizontal to vertical. You can see a huge increase, which was found to be good for training the model. In the first sample run, we got a training and testing accuracy of around 99%. Loss was found to be around 1.26% for training and 1.23% for testing. In our case, the accuracy of the model doesn't mean that the fund is consistently beating the benchmark. It only means that the model correctly classified a stock. In the graph, there are a couple of occasions when the benchmark has performed better than the model, like at the start of October 2018 and also towards August 2019. However, you can see that the model has performed much better for much of the time series. With 70-30 split, the model has performed pretty badly in this case. There are two major dips, one between December 2018 to April 2019 and the other in August 2019. Overall model performance was bad. In the third sample, the model ended up with a return of close to 14%, whereas the benchmark returned only 4%, so slightly better than the previous example. The fourth sample has the highest percentage of training data, so it's obvious that the model will train better. This means we can expect the performance of the model to be better, as you can see from the graph. The fund has managed to consistently beat the benchmark for the entire duration. Let's take a look at the results for the second scenario. Here it looks like the fund hasn't performed all that well in those initial months, but later managed to beat the benchmark quite consistently, which is what we are expecting. The model was up by 18% at the end. In the second instance, the fund took some real time to take off. It was not until March 2019 that the model started creating wider gains compared to the benchmark. In this scenario, the benchmark hasn't really moved much. The model wasn't performing well initially, but really picked up after February 2019. It ended up with almost 80% returns. In the last case, the model performed badly only for a brief period in December 2018 to Jan 2019, but has later managed to beat benchmark consistently.
The results that we have observed thus far are very encouraging, as we are able to create a portfolio from the training models that can consistently outperform the benchmark. Although we are still at a very preliminary stage, we think that there's definitely potential in this area and definitely worthwhile to investigate further. We think that the fundamental factors of the companies as well as the valuations of the companies definitely play a role in the performance of these stocks rather than just simply weighting it based on the market capitalization as the current indexes are doing. Much more work is required before we can actually implement this in the real world. One of which were the simplification that we made where the number of stocks did not change throughout the whole period of time, while in reality new stocks are added or existing stocks are removed periodically. Another simplification that we had was we've basically dropped a lot of stocks where data are missing, but I think we need to spend more time into looking at why certain stocks are missing data and what is the best way to treat this problem. Another important factor that we have ignored thus far is the execution cost, where it will actually affect the performance negatively. So maybe we have to look into the frequency of how often do we rebalance the portfolio such that we can have a good balance between the performance as well as the cost.